Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Scott Nations, president of Nations Indexes, to discuss volatility levels in the Nasdaq-100 Volatility Index, symbol VOLQ, V-O-L-Q. Scott, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill.
Yeah, and it looks like VOLQ is a little bit lower than we have seen it in the past few months.
That's right. Getting back around 20, lowest level since the beginning of last year. We know last year was not a great one for stocks, so you would expect implied volatility as measured by VOLQ to be higher. But the fact that that most of the indexes seem to have found a bottom and are working their way back, and also the fact that the biggest names in the Nasdaq 100 seem to have found a bottom and are working their way back, is working to mute volatility a little bit. Also, the fact that earnings season seems like it's going to work out pretty well. And the fact that the biggest names in the Nasdaq 100 don't report until next week, it's all another example of why implied volatility as measured by VOLQ is going to be tamped down a little bit.
Right, but of course, the risk is if these names do not perform well during earnings, and even outside of earnings season, that really is what's going to skew volatility in the Nasdaq 100 Volatility Index or any of these indexes where they are heavily weighted to these bigger names like Apple, Microsoft, Tesla, Netflix, NVIDIA, because Nasdaq 100 isn't the only one where these constituents live in other indexes.
That's absolutely right. And while we get Apple and Microsoft next week, you mentioned Tesla, we get Tesla tomorrow, but you're right. The biggest names in the Nasdaq 100 have tended to do really well as the stock market rebounds. It's that is the reason that the Nasdaq 100 is up nearly 19% year to date, way ahead of all of the other major indexes. And that's because the biggest names in the Nasdaq 100 have done well, Apple and Microsoft, for example. So the risk is that one or both of them really disappoint, and that would really be difficult for the stock market. But that said, there's no reason to think that that's going to happen. Both of those companies would have been expected to pre-announce, bring down expectations if they thought they were going to fall short. So given the fact that it seems like the Fed is going to slow down a little bit in some manner, I don't care if you call it a pause or that they're just going to stop here, that's likely to be pretty good for technology names. Again, less volatility, lower implied volatility, lower VOLQ.
Right. And then, Scott, of course, you can take a look at the individual volatility on a specific stock and to help you determine perhaps the percentage of the range that's expected after the earnings print, whether it's to the up or downside. Does that seem to be relatively muted as well?
Well, interesting that nearly every equity option is going to show that people are more interested in buying puts and selling calls. That's almost always the case. That doesn't mean that they expect the market to fall. It just means that they want to protect themselves in case it does. For example, the fact that you have homeowners insurance doesn't mean you expect your house to burn down. You just have to be prepared and insured in case it does. But we don't see a tremendous amount of extra fear if we look at options on either names like Microsoft or Apple. We just don't see that right now. And so that's really the way to measure it. Again, we're going to see more interest in buying puts, more interest in selling calls on these names. That's just the way the world works. But we don't see extra fear. That is, we don't see extra put buying out of some sort of fear that these are going to disappoint next week.
I'm sure it's also helpful that we don't have a Fed meeting in the month of April. It doesn't occur till May. So you kind of have that element removed from it, not even just with tech stocks, but with the market overall. That variable has been removed because really, Scott, the market, stocks have been moving on, let's say macro more so than fundamentals as they're trying to determine what the Fed's interest rate policy looks like.
Right. It's a little bit hair-raising when we get into earnings season. But Jill, as you pointed out, we want stocks to move on fundamentals. We want them to move on whether or not they're making money, how much money they're making. We don't really want to roll the dice on what the Federal Reserve might do next month or the month after. And so this is relatively healthy. Again, it's not always easy to take, but it's relatively healthy. And also, as you pointed out, since we have some time before the next Fed meeting, we're going to get a fair amount of data, both inflation and jobs data, before they meet again. Most recent CPI, for example, was a little bit better than expected, but just barely. But there was something for everybody there. So it was a little bit lower than expected. That's good. But it was still very high on a relative basis. That's not so good. And the fact that we're going to get more clarity before the Fed meets again, that helps.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.